Right, learners, in an earlier lesson I spoke about the current accounts. And remember we said that in a partnership you have a separate current account for every partner. And the purpose of the current account is to show how much profit, what earnings each partner has earned, and to take off his drawings against it. So if we just look here, this first partner, he had an opening balance, he earned some interest and a salary, and the appropriation was his final share of the profit. He had already taken some drawings out, and so we could work out what we still owe him. Now, in a balance sheet of a partnership, we have to detail out the current account note. And this is the exact same as your current account ledger account. It's the same details. But because it's not a ledger account, it's not set out in debit and credit, it is set out a bit differently. In fact, it's set out in a more user-friendly manner. So let's just have a look if we can see where all these figures come from. Now, first of all, in this original exercise, I had a profit of 480. That will be my total profit here, 480,000. Now that full 480 has to be divided between A and B. So that's what we're looking at, these two totals, and these two must equal to that. But now, when we divided this, remember, we gave salaries, we gave interest on capital, and we gave a bonus. So the identical figures here are what is going to go into here. And so, all I've done is I've inserted the figures. Exactly the same as we had in that previous current account. What is the salaries, what is the interest, what is the bonus? And then I've added this up, and this is the primary distribution. And I spoke about this before. The primary is the first distribution. It will be laid down in the partnership agreement what salaries, what interest, and what bonus has to be paid. And so that becomes our primary. So we've paid out an amount of 255, and that's how much of that has gone to A and B. Now, the final division. Remember, we had 480. We've already paid out, allocated 255. So if we subtract these two from each other, we are left with 225,000. So these two here must equal that 480. And then in the previous exercise, we said we were going to divide this equally, and so they each got 112,500. And once we've now given them their final share, we can now, remember this is in a block, so we want an answer, and so A had 100,000, his final share, and that is what's shown at the top. That is his profit per the income statement. Partner B earned these amounts, 155. He got a final share, and that's what he earned of that profit. Very importantly, if at this stage you need to add these two, and it must account for the whole 480,000. Right, now that's just taking into account what he's earned for this year. But we know that they both took drawings, and the drawings will actually decrease what they've got. So, as per our original, A had a drawings of 51,000, B had a drawings of 70,000, and the total will be 121,000. Now, this retained income, the word retained, is how much is being kept of this year's income. So if you look at A, he actually had 112,500. He's already taken out 51,000. So he's retained for this year only. How much of this year's profit is still here? Is 161,500. And so B has retained, he's left in the company 197,500, and that's just the total that you can agree with. Now, this retained income is actually extra capital for the business. It's the cheapest form of capital for them. One of the questions you often get asked when you're looking at ratios and that is whether a business should take out a loan because they want to expand. And there are pros and cons of that. But If the partners can leave money in, that is the cheapest source of money. They're increasing their capital. Hopefully that will mean more profit in future years, so they will actually gain in the long run instead of taking it all out. Now that's what they've got left for this year. But if you remember, back in our exercises, they both had an opening balance. This is money left over from last year. So that was the retained income at the beginning of the year. It's the opening balance. And please watch, learners, it is possible that this can be a debit balance, in which case it'll be a negative balance. So there was 131,000 at the beginning. So if we look at A, he's got 161,500, plus he had his 80,000, and that gave him, he's now got a balance of 241,500. And if we look back to the current account that we did earlier, that's exactly what his balance is. So all I've done is taken all these details and I've put them into a note where I've only used plus and minuses. On the other hand, B is 248,500, and the total of that would be, if you were doing a balance sheet, what would go into the balance sheet as your current accounts, the total. That is how much this partnership has got invested in the current accounts. So learners, try and see this logically. You're looking first of all at the returns for this year. What has they earned? Primary and secondary, and you've got their profit. They've taken some of it out. What have they got left? Bring in their opening balance, and what have they got at the end?